Okay, so we have discussed that audit risk is the risk that the auditor may give the incorrect audit opinion on the financial statements being audited. And let me write this again. So audit risk is the risk that the auditor may give the incorrect audit opinion on the financial statements being audited. So the risk in the audit is that the auditor may give the incorrect audit opinion. So if the auditor, for instance, is giving the incorrect audit opinion, then this is going to be a huge negligence that is in. And the client going to sue the auditor that why you have given the incorrect audit opinion. And again, if it happens for once, and if the news goes into the market that the auditor has given the incorrect audit opinion, then obviously it's a reputational risk for the firm as well. So the firm cannot afford to give the incorrect audit opinion by any means. So they have to make sure that they are giving the correct audit opinion. Now, where this incorrect audit opinion thing is coming from, I told you that whenever we are auditing the financial statements, there are two risks. The first risk is that the financial statement may contain material misstatement. And obviously, that's why we are there. That's why we are auditing the financial statement, because there is a possibility that the financial statement may be manipulated, window dressed. There may be creative accounting in it. There may be errors in it. That is why we are there to audit the financial statement. So financial statement may contain the material misstatement. This was the first risk. And the second risk is that the auditor may not detect material misstatement. So these two things became the reason of the incorrect audit opinion being given. That if there are material misstatements within the financial statements, and if they remain undetected by the auditor, then the auditor may give the incorrect audit opinion. Now, the auditor needs to reduce this risk. This risk should be reduced. And I've given you the example that how we can reduce this risk. The first way of reducing this risk, the first method of reducing this risk is taking the detailed understanding of the audit client. So when we say the detailed understanding of the audit client, we need to understand each and everything of it. We need to understand their accounting policies, their pricing arrangements, their product, their industry, the related laws and regulation, their major customers, major receivables. Now, why we will be taking the understanding of their receivables, their payables, their prices, their products, their warranty structure, their group structure. The reason for that is that when we are taking the detailed understanding of the entity, it will help us to identify the risk of material misstatement. That means we have to conduct the risk assessment. Now, why this risk assessment is necessary when we have to do the testing later? Why we are assessing the risk at the planning stage of the audit when we'll be doing the testing of the financial statement later? So the answer to this question is simply that we are identifying the areas where there may be a material misstatement, where there are chances of the financial statement being materially misstated. We'll be making the list, okay, inventory may be misstated, revenue may be misstated, provisions may not be recorded, inventory may not be recorded, a lot of cost NRV, depreciation may be incorrectly charged, research may be incorrectly capitalized, etc., etc. We'll be making the list of those things. So when we are making the list of those things, that will help the auditor later on in the testing stage to get the evidence over those things. And obviously, it is going to give the confidence to the shareholders as well. When we will be giving them the report, the audit report, we'll tell them, okay, when we were at the planning stage, we did the risk assessment. We identified this different risk related to, for example, IS2, related to IS38, and things like that. We'll be telling them that these were the risks which we identified during the planning stage. when we conducted the risk assessment. And later on, we have collected the evidence on those things. And now we are quite sure that everything within the financial statements is correctly recorded. So this is going to give the shareholder confidence that, okay, we are not giving this opinion blindly. There is a lot of testing behind that. Firstly, we did the risk assessment, and then we gathered the evidence on those things. And that is why we are giving this opinion that the financial statement gives the true and fair view. So taking the detailed understanding of the entity and then identifying the risk of material misstatement will help the auditor to reduce the audit risk. Because when we know the areas where there may be a material misstatement, and eventually then we gather the evidence on those things, that means everything is being checked. No, it's fine. Okay. So there's less chance of giving the incorrect audit opinion. So I give you the few examples that they said you were taking the understanding of the entity, and they gave you the information that they offer warranty. So you directly thought about that the provision may not be recorded. They told you regarding research and development, and directly it came to your mind that research and development may be incorrectly classified. And then they gave you the example, for example, of the revenue recognition, and then it came to your mind that revenue may be incorrectly recorded. And then you made a list of all those things, and eventually you will be testing everything later on the testing stage. So the important thing is that whenever you have this audit risk thing, you have to relate this with the financial statements. Always relate this with the financial statement, because it's simply the risk of incorrect treatment being performed by the management. Or you can say it's simply the risk of material misstatement. So whenever you have the audit risk thing, you have to relate that with the financial statements. If you are not relating that with the financial statement, that is going to become the business risk. Now, what is business risk? Now we are initiating another topic, the difference between the audit risk and business risk. And I'll explain this thing directly with the help of an example. The example is, in the case study, it is written receivable is struggling to pay. Receivable is struggling to pay. Now, this is what is being written in the question. Now, I've already given you the flavor that whenever you have the audit risk thing, you have to relate that with the financial statements. And when we say financial statement, it simply means either the accounting treatment of it or the accounting impact of it. The accounting treatment or accounting impact of it. For example, receivable is struggling to pay. Now, what is the accounting of this thing? Receivable is struggling to pay. Allowance for struggling receivable should be recorded. Allowance for struggling receivable should be recorded. If the allowance is not created, assets and profits may be overstated. Okay, receivable is struggling to pay. Now, what is the impact? What is the accounting treatment? That allowance for struggling receivable should be recorded. Ideally, there should be allowance for the struggling receivable. This is the correct accounting. This should have been done. But the risk is if the allowance is not created, that there's a risk that allowance may not be created, allowance may not be recorded. And as a result, assets and profits may be overstated. We are not quite sure whether they have created the allowance or not. It's just a doubt we are having in our mind when we are at the planning stage. It's just a risk we are having in our mind that maybe the allowance is not recorded. So we'll be making a list of it. Okay, we'll be writing this thing in our list of the risk of material misstatement. Okay, so there is a risk that allowance may not be recorded, and later on we'll be doing the testing, we'll be checking it. Now, if you're writing this receivable is struggling to weigh in this way, that struggling receivable might not pay, and this will be eventually a loss of revenue for the company. Now, if you're writing this way, then you're thinking like a businessman, that if the receivable is not paying, this is going to be a loss of revenue. Then that means loss of revenue, the loss of profit. That means this is a business risk and not the audit risk. Being an auditor, you should not be concerned whether the receivable is paying or not and how much it is paying. Being an auditor, we should be concerning regarding the accounting for this receivable. Let me give you another example, and then you will have a better grip on it. So another example is damaged inventory. Now, whenever we have the audit risk thing, the hint is being told that relate that thing with the financial statements, accounting treatment, accounting impact. So according to IS2, inventory should be recorded at lower of cost or NRV. Damaged inventory should be written down to NRV, if any, if there is any. If this is not the case, or you can write in a way there's a risk. If this is not the case, assets and profits may be overstated. Look, being an auditor, we are only concerned regarding the treatment of the damaged inventory. At the planning stage, they told us that we are having some damaged inventory this year. So we directly brought that point into our mind. Okay, it should be recorded at lower of cost NRV. There is a risk that it is still recorded at cost rather than NRV. And as a result, assets and profits may be overstated. This is the audit risk. But if you're writing this in a way that damaged inventory may not be sold or sold at very less price, resulting in the loss of revenue and profit. Now, this shows that you are thinking like a businessman and not like an auditor. You are concerned that for how much this inventory is going to be sold or whether or not this inventory is going to be sold. This is a businessman thinking, a businessman thing. Being an auditor, you should not be concerned whether this inventory would be sold. You should be only concerned regarding the accounting of that inventory, whether that inventory is being correctly recorded within the financial statement. So if you're relating that thing with the loss of revenue, loss of profit, then it is going to be a business risk and you won't be getting any marks for it in the exam. So business risk is not in F8 syllabus. It is part of the P7 exam. Here you are just supposed to write the audit risk. So everything should be related with the financial statements. So remember this tip. Whenever you have the audit risk thing, relate that with the financial statements. And you have to bring accounting treatment or accounting impact of it to your mind. And the risk is opposite to it. Okay, let's take a few more examples. So what I'm saying is bring accounting treatment or accounting impact to your mind, and the risk is going to be opposite of that. Now, let's take few more examples. Example number 1. Entity sold the property, plant, and equipment. So when they have sold the property, plant, and equipment, this should be removed from asset register. Should be removed from asset register. This is the correct accounting treatment of it. When they have disposed the property, plant, and equipment, PPE has been disposed. This should be removed from the asset register. There's a risk that asset is still included within the asset register, and as a result, assets may be overstated. So you just bring accounting treatment to your mind, and the risk is going to be opposite of that. Property, plant, and equipment. And similarly, let's assume revaluation. Revaluation of PPE. Now we know when the revaluation is done, the revaluation gain or loss is recorded in the other comprehensive income. And the depreciation is charged on the revalued amounts and the remaining useful life. This is the correct treatment of it. So if they have done the revaluation in the question, then we'll be writing that, okay, revaluation should be performed according to IAS 16, revaluation gain should be recorded in the comprehensive income. There's the risk that revaluation gain or loss may be recorded in the profit or loss rather than at the comprehensive income. Risk is opposite to it. Depreciation should be charged on the revalued amount. There's a risk depreciation may be charged on the previous carrying amount. Now, we are not sure whether they have done this. This is just a risk we are having in our mind. And we'll be confirming it when we go to the testing stage later on. So you just have to bring the accounting to your mind, and the risk is going to be opposite of that. For example, if they offer warranty provision should be recorded. There's a risk warranty provision may not be recorded. Inventory should be recorded at lower of cost NRV. There's a risk inventory still recorded at cost rather than NRV. Risk is going to be the opposite of that. Research should be expensed out. There's a risk research may be capitalized. Opposite thing. Development should be capitalized if the criteria is met. There's a risk they have capitalized the development even if the criteria is not met. So risk is going to be opposite. For example, shares issuance. Let's assume there is a share issuance. Shares are issued. Shares issuance. Now, when the shares are issued, it should be correctly split between the share capital and the share premium. The par value goes to the share capital. The premium goes to the above goes to the share premium. So there's a risk that the issuance of shares may not be correctly split between the capital and the premium. Just bring accounting to your mind, and the risk is going to be opposite. But there may be some risk in the question which does not have the accounting treatment, but it has the accounting impact. For example, these are the very important thing to understand. The first example I'm going to give is the finance director. Finance director left the company. Finance director left the company. Now, obviously, there's no accounting treatment of this thing. Finance director left the company. It is not same as the property, plant, equipment, the revaluation, the shares issuance. Finance director left the company and no replacement yet. And there's no replacement yet. No one is there. Now, there's no accounting treatment of it, but there is an accounting impact of it. What is the accounting impact? If there's no finance director, then the burden or the accounting work, accounting load will be transferred to the other staff. The other staff may not be sufficiently qualified to deal with the financial reporting issues, and as a result, financial statement may be materially misstated. So see, there's no accounting treatment of it, but there's an accounting impact of it. That if there's no finance director, no one will be there to deal with the financial reporting issues, the complex issues. And there's the risk that the current staff may not be sufficiently qualified to deal with those issues. And as a result, they may perform the incorrect accounting treatment and financial statements may be materially misstated. So this is a risk which does not have the accounting treatment, but it has the accounting impact. Now, let me give you another example. No bank reconciliation. The entity does not perform the bank reconciliation. Now, there's no accounting treatment for the bank reconciliation that it should be related to any standard. No, it cannot be related to any standard. But why the bank reconciliation is performed? Bank reconciliation is performed in order to reconcile the differences between the cash book and the bank statement. If it is not being done, then the cash book and the bank statement may have unreconciled balances, and as a result, cash at bank balance may be materially misstated. So even though it does not have the accounting treatment, still we are relating it with the financial statement, because if you say the bank reconciliation is not being performed, it will result in frauds. Now, this is a business risk. This is a business risk. Even if you are writing the no bank reconciliation is performed, this will result in entity being unknown to their cash position. Again, this is the business risk. The financial statement risk or the risk of material misstatement or the audit risk is when you relate it with the financial statement. No bank reconciliation is performed. Bank reconciliation is performed in order to reconcile the balances between the cash book and the bank statement. There may be unreconciled differences, and as a result, cash at bank balance may be materially misstated. Now, this is the audit risk. Similarly, we have lots of examples. For example, the third one is no vendor reconciliation, supplier reconciliation, or vendor reconciliation. Vendor reconciliation or supplier reconciliation is where we reconcile our ledger with the supplier's ledger, just to make sure that we have the similar balances being recorded. So if no vendor reconciliation is being performed, then the balances may differ, and as a result, incorrect payables may be recorded within the financial statements. And if you are saying no vendor reconciliation is performed, this will result in incorrect payments being made to the supplier. Then this is the business risk. So no vendor reconciliation is performed, you have to relate it with the financial statements. That no vendor reconciliation means that the balances may differ, and as a result, incorrect payable balance may be recorded within the financial statement. This is the audit risk. So even if it does not have the accounting treatment, still it has an accounting impact. So whenever you have the audit risk in the exam, you have to relate that with the financial statements. Otherwise, it is going to be counted as the business risk.